Every year, thousands of new investors ask the same question: silver or gold? Today, I'm going to show you the 3 finance tips beginners almost always get wrong, and the one framework that actually works in 2026. Here's what's changed: geopolitical tension, a weakening dollar, and industrial demand nobody predicted 5 years ago have redrawn the entire precious metals map. And right now, a new wave of investors is entering this market, most of them for the first time. They're scared. They're searching for answers. And the mainstream financial online, it's built for a world that no longer exists. We're covering 3 mistakes beginners almost always make, the real difference between silver and gold as asset classes, and a 3-part framework that will tell you exactly where you should be putting your money right now. Stay until the end. The framework in the final section is the part most people never figure out on their own. Let's start with the 3 mistakes, because before you can make the right decision, you need to understand why most people make the wrong one. Mistake number 1, treating silver and gold as the same asset. They are not. Gold is a monetary reserve. Central banks hold it. Governments hoard it. It moves with dollar strength and geopolitical fear. Silver does all of that, and it's an industrial metal. Solar panels, electronics, medical devices. Silver is consumed. Gold is stored. That distinction changes everything about how you position each one. Mistake number 2, buying based on price per ounce. The price per ounce is irrelevant. What matters is the gold to silver ratio. Right now, that ratio is sitting historically high, which signals one thing: silver is undervalued relative to gold. Mistake number 3, the round trip trap. This one destroys more beginner investors than anything else. They buy silver when it's rising. It dips. They panic and sell. Then they watch it recover and they buy again, higher than before. They've made a round trip and lost money on both legs. The way to break this pattern is to have a specific framework before you buy. So let's talk about gold first, because gold has a very specific job in 2026. JP Morgan has a $6,300 target for this year. Wells Fargo, $6,100 to $6,300. UBS, $6,200. These aren't retail analysts. These are institutional desks with direct exposure to central bank purchase flows. And central banks bought 755 tons of gold in 2025. They are not buying gold to sell it back to you at a profit. They are building reserves because they believe the dollar system is under structural pressure. What that tells you is this: gold in 2026 is a monetary hedge. It belongs in your portfolio as a defensive position, a stabilizer, not your highest upside asset. If you're new to hard assets, think of gold as your foundation, the part of your portfolio that holds its value when everything else is in chaos. Silver is a completely different conversation. 5 consecutive years of supply deficit. China has classified silver as a strategic material and restricted exports. Solar panel manufacturing consumed a record amount of silver last year, and that demand is accelerating, not slowing. Meanwhile, mine supply cannot keep up. The math here is not complicated. Silver in 2026 is not just a monetary hedge. It is a supply-constrained industrial commodity that also carries monetary value. That combination has never been more relevant than it is right now. The risk: silver is volatile. It dropped 37% in a week during the last panic. That's exactly why beginners get burned. They see the drop and they exit, right before the recovery. Which brings us to the framework. I call it the 3 defense lines, and it's the answer to the silver or gold question that beginners never get. Defense line 1, junk silver. Pre-1965, US coins, 90% silver. No premium over spot. These are your entry point. They're divisible, recognizable, and liquid. In a crisis, you can use fractional silver in ways you cannot use a 1-ounce bar. Beginners should start here. Defense line 2, government bullion. 1-ounce coins from sovereign mints. American Eagles, Britannias, Maple Leafs. This is where you build your core stack: silver and gold. Defense line 3, strategic cash. This is the one nobody talks about. Holding 15 to 20% of your hard asset allocation in cash gives you the ability to buy the dips that beginners panic about. So here's your answer to the silver or gold question. It's not silver or gold. It's silver and gold, deployed through a framework that protects you on the downside and positions you for the upside. Watch 2 numbers, the DXY, the dollar index, and the 10-year Treasury yield. When the DXY breaks below 97 and the 10-year falls below 3.5%, the mechanical suppression that pushes metals down during conflict and panic will have exhausted itself. That is your signal, not a feeling. Beginners react to prices. Experienced investors watch conditions. Now you know.